And for me, what I've always loved is street art. I've just always been a big fan of it. And Richmond itself has got an
Frank also
incredible.
likes street hot dogs and street tacos. Also, just I think it's worth adding that in.
If we're really going to go down this
Sorry,
road,
did I interrupt your? Did I
like
interrupt
pretzels.
I'm sorry.
I love the pretzels and I love the hot nuts. Like I can't wait to take my son to New York and say, "Hey, Max,
Street
hot
corn.
nuts."
He likes the street corn when there's lots of salt and butter on it. He likes that too. In episode 41, we talked about raising $4 million in 60 days for a real estate venture. And that deal went through. We did close on it, and we've been working hard on it ever since. In this episode, we give an update on all of the amazing things that Frank's team has been doing to raise the value of that property in a very short period of time. We update how the terms of that deal went with the investors, what we asked for from each investor, minimum requirements, and what the investors get in return. And we talk about how to deal with inflation using real estate in a pretty crazy market.
You're listening to Let Me Speak to a Manager with Frank Cava and Ian Mathews.
What a crock of shit.
Yeah, that was hot mic, Sam.
You can't say God on the air.
Don't worry, nobody's listening anyway.
Do it live! I'll write it and we'll do it live!
Frankie,
Ian, you son of a bitch.
you look, you got a nice trim today. Got a nice little barbershop stop.
I did. Sadly, I got a haircut like over a week ago. My hair is just growing slower, which leads me to believe that the next iteration is it's going to stop growing. But
the next iteration is going to grow white like mine. For whatever reason, you don't have white hair up top. Just it's all in your chin.
For some reason, you don't have wrinkles. I don't understand this. So somehow or another, you're defying gravity with your wrinkles.
So funny story. So
Frank, are we going to talk real estate, or are we going to go to a beauty regimen?
No. Frank's wedding. He hooks us up. So all of the men in his wedding takes us to a barber shop in the morning, and this is Frank's barbershop, so he's very excited about it, showing it off. And it's super cool barbershop. We had beer set up. It was an awesome experience. But we all get shaves. And I'm not the hairiest guy, so I'm a pretty easy guy to shave. It shouldn't be too tough to shave me. But all of us are like lining up, getting the hot towel, the whole thing. But a few of Frank's boys are hairy, like werewolf hairy. And it's awesome. So we're all like laying on the chairs, we're getting hot towels, getting shaved. And then we all kind of get out of it, and we're drinking beers, and we start comparing notes. And I'm like, hey, Nickel, they missed about 7 patches. Like he's just got blotches of hair sticking all over his. So the best part of the whole story is we spent like 2 hours at this barbershop drinking, and all of us end up in a bathroom with a Schick razor afterward, actually shaving because they did such a bad job of getting. I was the only one that didn't have too many blotches, but that's only because I'm not the hairiest guy in the first place.
It's true. Sadly, I had to touch mine up too.
You did. You needed a touch up too. The experience was great. Shave, kind of shitty.
Photos were great. We had root beers with my nephew. It was awesome.
Yeah, it was a nice morning for sure.
It was a nice event.
So this all happened in Richmond, and not terribly far from the Westwood project that we're doing actually. So we did an episode a few months back, 4 months back, maybe 5 months, where we talked about putting together a security for all intents and purposes with 3 commercial properties. And we talked about how we were going to structure it. And it was actually a really fun episode because we really weren't completely sure how we were going to pull it off at the time. We just kind of thought through, here's 3 assets. Here's multiple ways that we could fund it, either with debt or with private capital. And what came out of it was great. We ended up raising, had an incredible raise, and a number of people who invested with us on that deal were people who listened to this podcast and then just approached us and said, "Are you still looking for money on that deal you were talking about?" There were a couple in Richmond that approached Frank and I. There were a number of them that are here in Vienna. I had a guy approach me in a dugout at a Little League game saying, I listened to your podcast. That sounds like a great real estate deal. Do you need money? And it was like, sure. So it was pretty neat. So we raised $4 million, was it, Frankie?
4.5 total.
4.5 total in private capital. And that was when did we close on that? We closed on it
we closed right around, you were in a bit earlier to help me get it to the finish line, but we closed the deal. The funding raise closed October 1st. So it was really easy to do paperwork. It's closed right around the Q4, beginning of Q4.
Yeah, I sent Frank a couple of Venmos to get some progress payments going, and then we raised the rest of the capital. That's how Frank and I do business. We throw absorbent amounts of money towards each other without contracts. One of these days, we should probably look into the orderliness of our affairs, but it's worked so far for us so far. A handshake deal, old school. That's how we did it. That's how we did it back in Sicily, back in the old days.
Blood is thicker than water, Ian.
For sure. So Frankie has been busy at work. There are 3 properties. One is a church, and we'll get to that one, but we haven't started on the church. And there are 2 deals. We call it the Westwood deal because of the general neighborhood that we're acquiring in, and Frank is acquiring other properties there. But one of the properties Frank has put a good amount of money into, and it looks fantastic. I just got a chance to see it a couple of weeks ago. So Frank, why don't you talk about the Malvern building and talk about what you've done. Talk a little bit about the kind of where you've invested money in it. And probably more than anything, talk about when you take a building like that, you can overspend very easy and not get a return.
Correct.
So, I think you've been smart about how you've spent investors' capital so far. So maybe talk about what that building is and, what your vision of it was and how you've spent so far.
Yep. So the Malvern building is 2405 Westwood Avenue, and it is, it's on a historical register. It's a building that's been there since about 1960. It's a 1960s era building. So you're inheriting that. It's not super old for us, but it's also not new. But for what we renovate, it's kind of in our sweet spot. What it has is it's got 3 levels. It's got a below grade level or a basement. It's got a first floor and it's got a second floor. So what we've done is, first and foremost, is we fortified the basement. We made it from something that it had been vacant since the 80s because of water problems. And we knew that we had a solution for this. It took us a while to get a permit because we had to get through the city, but we had to change a door height and do some different things to be able to make it accessible. And once we make it accessible, we had this pro-forma at $14 a foot, vacant for 30 years or more. We had a pro-forma at $14 a foot. We knew we can make money on this deal if we couldn't rent it, but we thought we would be pretty good at pro-forming out $14 a foot. We're getting interest at $16.50 a foot. To put that in perspective for you, I don't have any leases signed, but what we're doing is we're going to be ahead of where we hope to be, where we land. But the first thing we did, Ian, is we fortified the building, fortified the structure. We updated the exterior. We painted it. We made it look nicer. We spent a bunch of money on windows. Like the windows that were in there are these 60s era windows that were hideous looking. And now we have like 21st century windows. And then we painted it, and we actually hired a local muralist to paint the side. And the reason that this is all relevant is because if you take a peek at it, there's a picture of it that you can see. That's what it looked like before. And I'll show you some afters in a minute, but this is the area there we had the basement, which has had all the water problems. And this is just another view of that. So what we did is first fortify. Second, renovate the things that matter the most. The exterior look, the windows, get that stuff done. Now we're working with the city on the permit. The goal is come bottom up and then top down. Everything on the first floor is in fine shape. It just needed bathrooms. So we already renovated those, even though we didn't have a permit. This is what we specialize in. We left the floor below open, and we left the ceilings not finished. So we basically just put drywall up so we could renovate what was in place. And if the county wants us to come back and inspect, we can. But while we're doing this, we actually are already raising the rents on the first floor. So well ahead of schedule for what we've promised our investors. And now that we have a permit, we got about 5 weeks of work to do in the basement. We'll start signing leases and people will be moving in March. And then the upstairs tenant will probably be moving in somewhere in the spring to early summer. So if you kind of attack it from both ways, you spend money on things that are going to get you stabilized first, rented second, and then a nicer return third. And that's what we've done.
So it's a nice building. It's an older building. And what you see in it as an investor is you see there are 3 floors. The bottom floor, which is a basement, is just a shell. It is making 0 rent. It has been making 0 rent. And largely that has to do with permitting. It wasn't permitted to be able to rent it out because of the flood zone area. Correct?
Right. Yep.
We've since fixed that piece, or in the process of fixing that. But if you see the basement now, the basement, Frank has chopped it up into a number of executive suites. So it's not, we could, if someone wants to come in and says, give me the whole basement, I'm going to put my whole company here. That's probably unrealistic because a basement's not always the most desirable. But you get someone like, you take me, my business, I have 3 different businesses that I'm involved in. I have an executive suite. It's not the biggest thing. It's nice. It gets the job done, but a lot of people just want a large office where they can put their things. So we had something making $0. Then now we're going to sell these little executive suites. These are going to go for what, $750 to $1,200 probably. Most of these executive suites, depending.
It's going to go. It's going to be very much dependent upon size, and we're thinking in something like literally, Ian, we're going to have them as small as like 40 square feet, like very, 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 very small. Like it's almost like a telephone booth that you can just come and set things up, but it gives you the flexibility where if you need to just have something to get away from the kids to do a Zoom call twice a week, so you're usually working at home, you could do that. But at the upside, we've got it in bigger ways. So we're going to kind of use the Airbnb model a little bit on the basement. We're going to see what the market gives us. We're going to build a shell, take it to market, and then we can very easily just close these things in and we can have them ready.
It's not, I mean, it's not exactly the WeWork model, but it's close. You know, there's a lot of people that they work from home. I was this model. You work from home, you have a home office, but your kids are around, COVID starts, it's too noisy. You got a dog barking. It doesn't feel professional when you're on the phone. Some people just want a place to put their things. I need a desk. I need to go put my books there, my files, my customer stuff. I'd like to have a place where I can just go talk on the phone without my kids yelling in the background. I need a place to go for a few hours because I think better if I'm in a individual place. So, for us, what really matters is you had 1/3 of this building getting 0 rent. Whatever rent we get is absolute bonus. Like the main floor, you walk in right off the street. We knew we could get the rents up 30-35% by investing. So, had old crappy carpet, nice new hardwood, had an old crappy bathroom that people used. Frank has turned this into a really nice bathroom that looks modern. It looks like something he would put into one of his new homes that he builds. All of the offices got a fresh facelift. They got new paint. The front of the building looks a lot nicer. The parking lot is getting repaved. So we've taken this from really borderline C asset, C space, old kind of neglected space, to not quite A, but B plus. So that main floor, all we needed on that main floor is to do our job, and it was going to go from $14 to $17 a square foot. So for us, that's a nice 25% increase in rent. And that's not even including the top floor, which we're going to put an anchor tenant in. But then you throw in the basement, and the basement's all just gravy. That was some of the most exciting piece to me is whatever you get out of that, as long as it's not a big expense to have to manage it, people coming and going, that's all gravy on top of the pro forma.
Correct. And that's how you buy an asset, and how you turn an asset from what can be a nice base hit into a double or a triple or a home run, is you have some things that you can do both value add And if you're sophisticated, smart, or can, properly navigate, which is what we do, you turn something into currently collecting no rent to being able to collect big rent. And those things change the dynamic of a deal.
Something else I think that's important about this, we have 2 properties, and Frank is he's paying close attention to the neighborhood. He owns multiple assets in this neighborhood, even outside of the 2 Westwood properties that our investors invested in. But he's taking care to make sure that the aesthetics of the outside of these buildings look in, because if you can acquire enough property in a specific area, you can have an influence on how the neighborhood looks and how it's perceived by potential tenants that are coming in. So Frank, talk about the mural that you put up on the side of one of the Westwood buildings.
Yep. So what I ended up doing with this is it's a couple fold. When you get into real estate development or any type of business that you might own, you get a chance to do things that you're passionate about. And for me, what I've always loved is street art. I've just always been a big fan of it. And Richmond itself has got an
Frank also likes street hot dogs and street tacos. Also, just I think it's worth adding that in.
If we're really going to go down this
road, did I interrupt your? Did I
like
pretzels? I'm sorry.
I love the pretzels and I love the hot nuts. Like I can't wait to take my son to New York and say, "Hey, Max,
street
hot
corn."
Nuts.
He likes the street corn when there's lots of salt and butter on it. He likes that too.
All true. So to that end, street art is something I'm a big fan of, and Richmond has an incredible culture of street art. And they've taken murals from kind of something that people would not want or they shied away from them. Instead, Ian uses the term lean in. Richmond leaned in. VCU is an arts college. Most of the creativity comes from VCU. These kids used to move away. They don't move away anymore. They stay in Richmond, which is fabulous. But this is in Henrico County. This is not in the city of Richmond. This is just on the outskirts. And what happens in a lot of instances is you don't see cool art in Henrico. You mostly see it in Richmond. So what I wanted to do is I wanted to kind of showcase that this is where we're going to go. And this is you, when you turn this corner, you are just before Topgolf and you're just before the highway, like you're getting into a new spot. On the other side of the highway is now a Carvana Tower, which I knew before we bought this building. And there's a bunch of apartments behind us, but I wanted it to be kind of edgy and hip. And initially what happened was I renovated the house in the Fan, which is where I used to live, the neighborhood. It's a walkable community. And this house was 3 blocks behind where I lived. And it was like on the way to Starbucks. And I remember I was either walking or driving and I was like, oh man, someone graffitied the side of this. Like they ruined the side of this house. Because the day I went by, it had like all this green spray paint on it. I went by like 2 weeks later and there was these incredible hands and it was a spray paint bottle. And I ended up seeing like who was the artist. I'm like, that guy has got it. He's awesome. So I went, there's a way in Richmond you can do this. I went around and see like, who are all the graffiti artists? Who are the ones that are the street art guys that are like, or ladies who are like highly promoted. And I kept coming back to this one artist. So I reached out to the owner. I said, can you put me in touch with the artist? The guy who bought the house from us, he did. So what happened, Ian, is I'm sure I've asked you this before. Have you ever heard of the Awakening statue in Washington, D.C.? You ever seen it?
Yeah, over at Haynes Point.
Right. So it was in Haynes Point and they moved it to a different part of the world when they did all that stuff in Maryland. But what I'll show you is when I was a little kid, I went to Washington, D.C. and I saw this for the first time. And I thought it was so wicked cool that I wanted to do something like this. So I was like, it's called the Awakening statue. And
if you're listening, what it is, it's really neat. It's like a giant hand coming out of the ground.
Right.
It's almost like an old god that's like either drowning or kind of reaching out of the ground. It's really cool. And it's right at Haynes Point. There's like a 1 mile loop that's South DC that a lot of runners go to, bikers go to, do a little bit of a lap. But it's at the very southernmost point. Well, at least when I lived in DC, that's where it was. And really, really kind of cool landmark in DC.
It's been in a bunch of movies. I saw it when I was a little kid. It kind of seared in my brain. So what I talked to the artist about was I'd like to show something that shows that this area is awakening. Like, and I showed him a picture that I just put up. He's like, all right, cool. Give me about a week. So he came back to me and he gave me something completely different. He's an artist. This is what he does. He goes out and he creates. And what he created was something that was very, I don't even think I've ever showed you this, Ian, but it was very workmanlike. It was
You showed me
different.
that. You showed it was like the worker with the hammer and the tool belt. You showed me that.
Exactly. So we ended up getting we ended up getting a kind of a different rendering from him. And that was what we were going to go with. And then I spoke to him at the end and I said, all right, this is cool. I really like it. Let me ask you a question. Now, I manage a big staff and I know how to give people autonomy. And I realized I was controlling this process and I'm not an artist. So I was like, before we go, if I was going to give you free reign to do whatever you wanted to do on the side of this building, what would you do? He's like, interesting. I've never had a client ask me that before. And I've done murals all over the world. He goes, give me a couple of days. I said, okay. So he came back to me with a collaboration with this other artist where he's holding like this really, really cool flame up. And what we ended up doing is we ended up putting the window where his hands are. So we ended up, he calls me up, he goes, hey, originally we were going to just do like a quarter of this wall. Do you care if we go further? I go, no. And then he called me up again. He goes, do you care if I do the whole wall? I'm like, is it going to affect my price? He goes, no. I go, nope, not at all. So he ended up doing the whole entire wall. And he even wrapped around a little bit to the front. And the goal was to have a statement piece. Like, I want people to know that this is different now. And this has been the net result. We can show a couple of pictures of it, Ian. People literally stop and say, I don't want to rent anywhere else on this street. I want to rent here. And that was what I wanted to accomplish.
Yeah. So the goal is to make the building more desirable. So it's one thing to say, here's my address. If you got a client coming to see you in an office building, I'm on Westwood and here's the number. We're in Suite 2B. It's another thing to say, you can't miss it. It's the building with the graffiti art on the side of the guy with a beard and it's raining. Like, you won't be able to miss it. And then, you say that and someone says, I know exactly what you're talking about because I've seen that 5 times going to Topgolf or whatever going over there. So it plays to a little bit of ego. If you're a business owner, you have an office, you can say like, yeah, that's my building. I'm in that building. And all those little things are those aesthetic touches that allow you to ask for $17.50, $18 a square foot, $18.50. Ask for a little bit more. It's a little bit money up front, but this is an investment that we all knew going in could be 10 years or more. Our goal is to make the neighborhood as valuable as possible and to make it as desirable as possible so that people are happy to spend money to go into a neighborhood like that, and especially a growing neighborhood. So 2 of our buildings are well along their lines. I think it's important to say, so we raised $4.5 million of private capital. The investors that we had in this deal are investors that wanted some stability. So they want to know, is this safe? There's great cash flow in this. So they get an 8% yield. There's an 8% cap rate. So we've already paid,
pref.
Yep, pref. So we've already paid out the first payment. We paid it relatively quickly. It wasn't a full 3 months, but we paid it because we said we're going to pay quarterly on this schedule. Our next payment's going to be going out next week. They're going to be getting the full 8% that's coming out of it. As our rents start to come in and it does better, the next goal is going to be that as we get more revenue, we refinance and we take out some debt, right? We couldn't take out debt when we raised capital because obviously we weren't getting rent from the 3rd floor. We weren't getting rent from the basement. Certainly not the rent rolls that we're getting now. And as we get closer on the church, even more rent is going to start coming out. And when I say church, Frank, just give a quick 2 minutes of what's going on with the church.
Yep. So if you're cool, Dean, what I want to do, 2405 is the first piece of the puzzle. The second piece of the puzzle is 2323. It's just up the street. So we had a good anchor tenant up front in 2323. They have a lease that goes for 4 more years. We're not touching it. They're a good tenant. They pay, and they're at $16 a foot, which is really good. That building was empty from that point back. We actually leased the back part of the building above Pro-forma. to somebody who's using it as a storage facility, which is the perfect use for it. We pro forma it at $14 a foot. We lease it at $14.50, and we're working through our second LOI now for someone in the middle. So all of these things are starting to happen in only 6 months' time. What we've been able to do is we've been able to renovate what we could, stabilize, and now we're starting to drive towards something that's really starting to make sense for those two parts of the building, or the asset basket. On the church, we're kind of in a different spot on the church. We are this close to getting a building permit. We've actually brought in a consultant who's helping us get it through the finish line. And we as a company are probably going to bring in our own project managers to run it. Some commercial folks. The reason is supply is insane. Prices have gone ballistic. And because of these things, we want to be able to stabilize and get the asset improved for a better price. So what we're working on right now is how do we do that? And it might involve, but this is why I brought the deal. We have the ability to self-perform construction. So what we may end up doing is self-performing construction to take some of the price shock out of this. But these are things that happen. I mean, when we signed this deal up, we didn't know the supply chain was going to go all condensed. So those are the battles that we're fighting. But what we think will ultimately happen is we're going to have 15 units that are going to rent between $1,000 and $1,800-$1,900 a month, depending on the size. And we are going to be at, if not above, where we pro forma this. And this property will finish, if not late this year, early next, perfectly in line with what we lined up from the time frame with investors. And that's the goal. And we're already working with several banks in order to get, when they see this thing stabilize, we'll be able to take the investors out.
So in short, it's an old church. We're gutting it. We're turning a church. We're getting it permitted so that you can put residential in it. We are permitting it for condos. We are going to put 15 units in it. And, today that church makes no money. When we're done with it, it's going to make a bundle of money. So, and for our investors, we're still on track based on the 3 different assets, which are pretty well diversified because you got a mix of residential, commercial, storage. We are on track to do what we said we were going to do, which is give them their capital back in 18 to 24 months while letting them keep a percentage stake of the deal. So they get their money back. Every quarter, they are getting their 8% yield. So they're getting great cash flow out of this. The minimum that to get into this deal was $100,000. And they're getting their 8%. And then we're going to give them the capital back, but they're going to, even when they get their capital back, all their risk is off the table. They're going to retain an ownership percentage, and they're going to continue to get quarterly payments. And then 5, 6, 7, 8 years from now, when this neighborhood has realized its full potential, we're going to sell it, and we're going to sell it for a very big profit on top of what we bought it for. And our investors are going to get a percentage of that big bang when we get at the end. But in the meantime, in that 5, 6, 7 years, they can do whatever the hell they want with their capital because all their risks off the table. There is no longer any risk to them. They have equity in the upside. They do not have equity in any downside or risk once we give them their money back. So we're on track to take care of these investors just like we said we were going to do. A quick question just on this before we wrap it up. Inflation's been pretty crazy. Is that when we pro forma this, are you seeing anything different in your costs? So inflation is helping us on the rent side, but that's a double-edged sword when you get inflation because your expenses sometimes can rise more than what you can charge.
Yeah, so we're okay with inflation on what we've seen with the Westwood building. So, or 2405 Westwood Melbourne building. We're okay there. Nothing has gotten crazy. Materials, the things that we need to do, because it's mostly just a facelift, like it's not as prohibitive in cost as the church is, because the church is more of a down to the stud full renovation that requires more. So when I brought this deal to Ian initially, I said there's a lot of upside value in both of these buildings. And I think there's a lot of stability in the two 2405s, or 2405 and 2323, 2 buildings on Westwood. The church is more of a variable. But I do believe like right now there is it's a congruent relationship between the inflation and the amount more you're going to get in rents. And so we're okay. And we built this thing at such a low basis. We're still going to be just fine. But there are cost increases on the construction side, and it's really hard to find labor. So those two things are the reason why we're thinking about doing this in-house versus taking it to market, which I think will save some of that inflationary price increase.
Yeah, I only bring it up because I don't want to sit here on an episode and make it seem like every investment you do, everything goes perfectly to pro forma. The truth is we're probably going to do better than pro forma on revenue, and we're probably going to eat and spend more on expenses. And it's probably going to take a little longer to build some of these than we did, because when we put this pro forma together, inflation was not this out of control the way it is right now. So no investment ever goes perfect the way you think it's going to go. But I think in everything Frank and I have done so far together, and you know, I know all the things he does and he knows my investments, we're always very conservative in thinking about the worst case, and thinking about our floor, and not trying to pro forma with hope that the market's going to help. We normally pro forma thinking the market's going to get worse. And when it does get worse, what does this thing look like? Whereas, and I think a lot of novice folks that get into the business, they project a little too much. They look at maybe the last few years and say, it's kind of like someone buying a stock saying, wow, the stock market's up 25% this year. I'm going to load up on stocks. It's going to do it again this year. And here's how much I'll make. No, you're not. You're not going to get 2 years in a row at 25% out of the S&P 500. You know, you see a lot of people doing it in crypto too. I think in real estate, you got to be really conservative in all your estimates. And, you know, whenever I go through these spreadsheets with Frankie, we normally just have like a whole line item that is just slush, that is just like, this is the FUBAR line item. This is, we know for a fact something stupid is going to happen. It's going to be expensive, and we're putting a chunk of money in here. So when it does happen, we're not apologizing to everyone that we didn't see that coming. Don't know what it is, but it's going to be something.
So let's talk about this, right? So I was on a call yesterday with someone going over this exact thing. And they were asking me about like where I'm positioned for business, what's going on, why, like, what do I do? Most of what we do, most of what we own, most of the assets we own are backstopped by the US government. And what I mean by that in English is the US government backs the rents because it's subsidized in some way. We provide a product and then Section 8 comes in behind it. When Ian and I put a deal together and we raised a bunch of money like 2.5, 3 years ago at this point, the pandemic happens like less than 90 days later. And we're both shitting biscuits because we're absolutely sure like this thing is going to go, in the parlance that we use, tits up. And we're like, we're just scared. So we're on the phone like multiple times a day. My money's in it, Ian's money's in it, and worst of all, our friends and family's money's in it. We're panicking. And then we had a conversation and we said, look, this could be a slower return. But what we did in this real estate deal is we have the ability to collect rents. So we're going to just not panic. We're going to take a deep breath. We're going to let the world settle down. The US government still paid their rents on April 1st, even though the pandemic had started. That was one of the first things that came out. The US government said, no, we're paying our rents. So look, we just took a deep breath. And then we waited about 60 days. And then the market started to get like incredibly hot and we readjusted again. But we were backstopped with solid rents. And that was what, and we just waited and we said, hey, this is where we're at. This is something unprecedented. And that's kind of how we got through that one. With this one, we didn't really use the basements. We didn't have to. We thought it could work. We were really low on the numbers. And if it didn't work out, we thought we'd still be fine. The other thing is what Ian said a minute ago is this is probably a CD asset now, which in real estate, if you don't know this, things are rated 8F. Like it's probably a CD asset the way it sits. I think this is a C plus, B minus type of an investment when it's finished, but we're going to be charging C rates. And we can do that because of how we built it and how we're doing it. Now, if the market goes crazy, we can rent for more, but where we pro forma'd was a nice C, C plus. And if we can get into the B plus range, that's just winning for us. But in a down economy, you want to think about, can you rent this where it's just silly, stupid, and people are going to say yes. And that's how we set this up.
And I think the nice thing about this one too, Frank, is you got 3 buildings. By the time the church is done, could be an A building the way you're designing that. If we really
Church
want to
should
go
be.
crazy, you know, one of the Westwoods could be a B plus, and the other one maybe is a B minus C plus. You got a little bit of a mix of all of that. You got a mix of rates. And that way you're a little bit diversified on the kind of people that are looking for space. So we didn't go all in on A. We didn't go all in on B plus. We didn't go all in on C minus. We're kind of all over the market. So we're hedged a little bit. But it's nothing ever goes perfect on all these things. So you have to think about the downside as much as you think about the upside. And you got to we thought through that. What if inflation happens? What if the economy takes a big downturn? What if unemployment spikes? What if there's a 30% drop in the stock market and people panic? What if COVID comes back in a major way and everything shuts down? All of these things are things that we talk before you go get people's money. You have to answer these questions. You have to answer them, and you don't have all the answers, but you have to say, okay, what will we do if these things happen? How will we handle it? And are we sufficiently hedged in certain ways that we could do different things? We're not all in on burn the boats with one strategy.
And I think this bears discussing. The RVA 7519 deal closed at the end of 2019, my 11th year in business. This deal closed my 13th year in business. I wasn't doing these deals year 1, year 5. I had to have a staff. We had to have people who could perform. And we have great people who make sure we can perform on the back end. And when you start to look at the bigger stuff, you need to make sure you have the ability to perform. Some of it's knowing your abilities and your limitations. And when Ian and I get into these deals, like our parents are in these deals, our siblings are in these deals, our friends are in these deals. The last thing we want to do is not to pay them back or give them what we promised. So we come in a very conservative, and the type of deals we'll do are ones where we think there's a high level of certainty, but even so, things can still go wrong.
I think the last thing I'll just say is, because inflation is all over the news, and it's on everyone's mind who owns any stock or thinks about the economy. Ultimately, if you own hard assets, you don't worry about the price of bananas and milk. If people talk to me about, have you seen gas prices? Have you seen? And I'm like, yeah, I own a shitload of hard assets and they're up a lot more than I've paid in bananas. So it's like in life, your goal has to be, if you're worried about inflation, how do I own enough things that are going to grow dramatically? And if you do that with debt, your profits are even bigger when inflation starts to hit in. If you can lock in low rates on a long term and buy an asset that's going to inflate while your rate stays steady, the amount of profit you can make on real estate in an inflationary market is insane. And you're not going to make money in an inflationary market in stocks at the same pace unless that company can raise prices more than its expenses. They're going to be in that world of their margins are kind of getting eaten up by expenses. So the things that you buy have to be the things that are going up. So a lot of companies' profits are going to go down because their expenses on things like rent and people are going up. Well, then what do you want to own? You want to own the things that are going up, and maybe own a banana farm and a dairy farm. Maybe own one of those too.
So I think this bears repeating, and there are two last things I think we close this. The first one is this. It's the advice I give every intern who ever works for me. This goes back a long time.
Timeless advice. I listen to it too.
Whenever there's an intern, I always sit down with them. I say, would you be willing to take, 2 pieces of advice from me? And then I'm the owner of the company. They all go, yeah, sure. That'd be great. I go, all right. Piece of advice 1, buy hard assets. I'm like, what do you mean? I go, real estate is the hard asset I believe in: gold, silver, titanium, platinum, whatever, but hard assets, things you can really, really, really touch. And piece of advice 2, don't get fat.
Really, really, really good advice on both.
But this time around, someone put on Facebook, and he and I have talked about that. I don't know if we talked about it here, but someone put on Facebook, like, what are you going to do to hedge inflation? And I called Ian up and I said, I'm going to buy 300 houses 10 years ago. The time to do it if you haven't already done, is now. You never know when that next wave's coming, but it's one of those things where nobody talked about inflation because it hadn't happened in 35 years. But here it is, boom. And people who own assets like Ian and me, we're no smarter than we were before. We were just smart enough to this is a good hedge and it's a good place to be and it's a nice return. So it gives you an opportunity to participate.
But I think inflation is one of those things that you don't think about it until it like slaps you in the face. Like most people just ignore it.
Correct.
One of my properties that I own, one of my industrial properties, in the lease, I have that rent increases are tied to CPI. And at the time when I negotiated that in, because this is a equipment rental company with a big publicly traded company, it was surprisingly easy to get them to put it in. And I actually paid a little higher price for it. When we were negotiating on price, I wanted that. And they were like, cool. And the reason why they were like, cool is because there hadn't been inflation since the 80s. So they're like, look at this fool. Everyone else is asking for 3% straight. This guy's asking for CPI. Well, for me, I was buying it for a different reason. I wanted an income that would protect me. But now it's made that property so much more valuable because I have a lease with 11 years left on it that is tied to CPI. So all these old men that have millions of dollars and don't know where to put it are fighting to get my property.
Define CPI for people who don't know.
Okay, so CPI is just an index. It's the U.S. index for inflationary products. So they take a basket of goods.
CPI is Consumer Price Index.
It's a basket of goods that stays steady, and they take a look at it every quarter, and they go do price checks on it. So you think about all your basic stuff. You think about gas. You think about milk. You think about groceries. You think about all basic expenses, human living, and that comes out with an index. And that index goes up, down, or stays flat. And typically inflation is 1.5%, 2%. In the first 2 years of me owning this property, that's what I got for rent every year, like 2.25%, 2%. Boring, right? Nothing exciting. This year, I'm going to get close to 7% increase on rent. And the bigger thing though, for me, Frankie, this is a 15-year lease when it was signed, or 14-year lease, whatever I had on it. So for me, the bigger thing is anyone who wants to buy that property from me is going to get that lease assigned to them. They are buying into a property with a tenant who is contractually obligated to pay higher and higher rent tied to inflation. So if you're someone who's worried about inflation hitting you, my property is so much more valuable than it would have been if I would have just done the standard 3% increases every year for rent. And so these are little things you can do to think about those things. But when I did it, no one was talking about inflation, and no one had been talking about inflation for 20, 30 years. Now, my tenant, which I won't mention the name, is probably looking at it saying, shit, that's a bad deal. I should have done 3%. But at the time, They were like, this isn't a risk. We don't care. We'll do that. And we'll pay, we'll sell the property for more.
I'll say two things. I work in a different business as a consultant. It's way more expensive to buy event insurance now than it was before the pandemic. You can't even buy it now. So it's impossible. The other thing with inflation, if you don't understand it, it's very, very hard to completely and totally comprehend, but it's kind of like a can of biscuits. You ever seen when a can of biscuits is busted? It's busted. It ain't going back in that can. It's over. It's kind of like that's what happens with inflation. When inflation happens, sometimes it pulls back, but it's very, very, very modest in pullback. Once that market is forged ahead, like those biscuits, they ain't going back in the can. So what Ian's talking about is there is risk because it's just not a standard number, but it's a very mitigated risk, and it's something that gives him upside. His entire goal was living on a fixed income, and he's worried if a dollar is not worth a dollar, I want to have it tied to something that's going in line with my loss of dollar power. So those are the two things, and I can tell a fat joke's coming. I can just see it on his face.
I am thinking about the fact that you have overly used the term biscuit in this episode. Sometimes Frank was born in the deep bayou of Fort Lauderdale, and sometimes he starts bringing out his southernism. So we've talked about shit.
Your boy Jay Connors the one who taught me about a busted can of biscuits.
We talked about shit and biscuits, which I've never actually shit a biscuit, and we talked about bursting biscuit cans of biscuits. But fantastic analogy, Frank. I think it was really good. I think we'll wrap this up. I think in general, we are 4, 5, 6 months into this security that we put together, and it's going really well. It's going to have its challenges, but I think it was worth us kind of unpacking where it is today.
For those of you that are at home and want to treat yourself to something fun, I recommend you Google busted can of biscuits and just see what comes up.
Aside on this, in high school, when we used to go out and mess with people, egging people, that's kind of, that seems a little juvenile. What we would do is we would get the Pop and Fresh biscuits out and we would whip them and throw them on someone's car. And if they didn't notice it the next day and the sun was out, it would bake the biscuit onto their car. It was a real pain in the ass. So if you had someone you didn't like, we'd whip a can of biscuits in their car for the next day. So that's a third biscuit story. I think we've jumped the shark on biscuits in this episode.
Yeah, we've also killed the fact that we should be looked at as credible in any way.
No doubt. Hey, Frankie, great talking to you.
Ian, you son of a bitch, it was a pleasure.